To note number 2. Question number 41, note number 2. On 1st July 2014, Alpha acquired 90 million shares in Gamma. So 1st July 14 underline, and you also check what is the consolidation date. 31st March 15. 31st March 15. So in this case, the gap is 9 months. 1st July 14, Alpha acquired 90 million shares in Gamma by means of a share exchange. Alpha issued 2 shares for every 3 shares acquired in Gamma. 2 by 3 into 90, 60. On 1st July 2014, the market value of Alpha's share was 2.90 and the market value of Gamma's share was 1.50. So for calculating the purchase consideration, this calculation we will use. Then it says the share exchange has not been recorded in the draft financial statement of Alpha presented above. So you have to pass this entry also. What is the entry you will pass normally? Investment account debit to share capital and to securities premium. Next line. Alpha also incurred directly attributable cost of $1.5 million associated with this acquisition and debited this cost to administrative expense in its draft statement of profit or loss. Right or wrong? Is it right or wrong? Directly attributable costs relating to acquisition charged to profit and loss account. So it should be charged to P&L account. They have used the heading administrative expense. So that is right. No adjustment required for that. Next line. On 1st April 14, the individual financial statement of Gamma. On which date? 1st April 14. See, be careful. 1st April 14, the individual financial statement of Gamma showed the following reserve balance. And what is the date of acquisition? 1st July. So I have to add current year's 3 month also to get the pre-acquisition reserve. The individual financial statement of Gamma showed the following reserve. Retained earning 45 million. And the profit for the year ended 31st March 15 accrued evenly over the year. If you look at the retained earning of Gamma, how much is that now? 51,000. 51,000. So what is the current year income? 6 million. And this 6 million also you will divide in the ratio of 3:9. 1.5, 4.5. So therefore, the total pre-acquisition retained earning will be 45 plus 1.5 is 46.5. Next line. Other component of equity is 2 million. So 2 million was already there on the date of acquisition, 1st April. See also the information provided in note number 3 regarding other components of equity. So note 3 we'll see later. Gamma leases all of its property on operating leases, and its plant and equipment comprise assets with relatively short useful economic lives. Therefore, on 1st July 2014, there were no material differences between carrying value of the net asset of gamma in the individual financial statement and the fair value of those net asset. So the entire paragraph, no effect. Okay, ignore. No impairment of goodwill on acquisition of gamma has occurred since 1st July 2014. Again, ignore. So they could have simply avoided this statement only. Note number 3. Other investment. What is other investment? Apart from in its investment in beta, the investment of alpha included in the statement of financial position as on 31st March 2015 are all financial asset which alpha has elected to measure at FVT OCI. So there may be some other investment also. There may be some other investment also in the books of alpha. And what is the presentation for those other investment? FVT OCI. All of the investment held by beta and gamma are also financial asset which beta and gamma have elected to measure at FVT OCI. So no problem. None of these investment have been bought or sold in the year ended 31st March 15. The fair values which are included in the draft statement of financial position above are the fair value on 31st March 14. Now these figures that you see in the balance sheet, those figures are of 31st March 14 for beta and on 1st July 14 for gamma. The relevant fair value on 31st March 15 are as follows. Now they have given you fair value of outside investment. Alpha's outside investments fair value is $33 million now. So first we'll have to find out how much is outside investment. Okay, how much is outside investment, and then after that we will pass one entry investment account debit to OCI account, fair value gain. Next is beta is 43. And how much is appearing in balance sheet? 40. So there is a gain here also, $3 million. Gamma is 11.60. And how much is gamma in the balance sheet? Gamma is 10. Again there is a gain here also. Next line. This you have understood. We have to just make adjustment in investment. We have to make adjustment in FVT OCI so that other component of equity will increase. Then next line, the change in the fair value of gamma's investment during the year ended 31st March 15 was caused by events occurring after 1st July 2014. That means all change in fair value will be treated as post-acquisition change. Okay. So you don't have to divide this into 9/3:9 ratio. Next line. You need not consider deferred tax implication of any gain arising on the remeasurement of this investment. Very good. Intercompany sale of investment. Intercompany sale of inventories. Now you are very familiar with this. The inventory of beta and gamma on 31st March 15 included components purchased from alpha in the last 3 months of the financial year at a cost of $15 million to beta and $10 million to gamma. Alpha normally earns a profit margin of 30% on sale of these components, but supplies of these components to group companies are routinely made at a reduced margin of 20%. So which number I will take, 20 or 30? Underline 20%. In the consolidated financial statement, any adjustment required as a result of this note will be regarded as temporary difference for the purpose of computing deferred tax. The rate of deferred tax to apply to temporary difference is 20%. You can assume that sufficient taxable profit exists in each entity to allow the deferred tax implication of deductible temporary difference. Okay, now come to the next line. So we'll calculate the unrealized profit and we'll calculate the deferred tax also on this. Okay. Next line. Trade receivable and payable. Trade receivable of Alpha included $9 million receivable from Beta and $6 million receivable from Gamma in respect of purchases of component. See note number 4 that we have read. On 31st March 15, Beta and Gamma paid $9 million and $6 million respectively to Alpha. So they have paid. Who have paid? The subsidiaries have paid. And so eliminated their trade payable balance in respect of purchase of component. So no adjustment in trade payable. Alpha recorded these receipts on 3rd April 15. So what we will do? Trade receivable we will reduce by 9 and 6. And cash equivalent we will increase by 9 plus 6. Will there be any impact on the liability side? No impact. In liability side the entries have already been passed. Now there is nothing due to the parent company. Note number 6. On 1st March 2015, the Board of Directors of Alpha finalized a plan to reorganize and reconstruct the group. So now IS 37 is applicable. The plan was publicly announced on 15th March 15. The plan involved closing down one of Alpha's operating units, that is Unit X, not a separate legal entity. The business of Unit X will not be discontinued. The other operating units of Alpha will be able to supply the unit's existing customers. However, all the PP being used in Unit X will be disposed of. Some of the employees working in Unit X will be made redundant and others will be transferred to other operating units of Alpha. The provision made by Alpha in its draft financial statement comprise the best estimate of the following. So they have made provision 8 million for redundancy cost. That is right. Cost of relocating employees to new location. You will not make provision for this item. Is it right? You will not make provision for this item. So this you cancel. Cost of retraining existing employees for work at a new location. This also cancel. So what you will do, your provision in the balance sheet, which should be 8, they have taken 12.5. So I will reverse provision of 4.5. So will it affect my retained earning figure also? Yes. So my retained earning will increase by 4.5 million. Is it right? This we had done in the earlier problem also. When will this question end? Some more lines. On 15th March 2015, the property, plant and equipment of unit X, which is included in the above statement of financial position, had a total carrying value of $15 million. $12 million of this amount relates to property and $3 million to plant and equipment. On 15th March 2015, all of the property, plant and equipment were offered for sale. Offered for sale means these are held for sale. IFRS 5 will apply now today. So in this question, one more standard they have tested. What is their carrying amount? Carrying amount is 12 million for property, 3 million for PPE. And now these are held for sale. The property was offered for sale at a price of 16.5 million and the plant and equipment of 1.05 million. Both of these amounts are considered to be reasonable price, which are achievable within 6 months of the year end. So this two item will be now classified as held for sale. What is the rule for held for sale asset? Carrying amount and fair value less cost to sell, whichever is lower. So the note says the estimated cost of disposal of the property was $500,000. Now its fair value is 16.5. 16.5 minus 500,000 is how much? 16. 16.5 minus 0.5. Say yes or no. 16.5 minus 0.5 is 16. Whereas its book value is 12 million versus 12. So do we need to make any adjustment in property? No. So property will remain at 12. But plant and equipment, whose book value was how much? 3 million. Now its selling price is 1.05 and its cost of disposal is 50,000. So 1.05 minus 0.05 you take 1 and the book value is 3. So in case of plant and equipment, you will have to write off by 2 million. Is it right? So write off by 2 million will affect your retained earning also. Is it right? However, none of the property, plant and equipment of unit X, which was being offered for sale, had actually been sold by 31st March 15. So they are still on the balance sheet date. So they will be presented as a separate line item now. Under a separate line we will write that non-current asset held for sale. You can assume any change in carrying value of property, plant and equipment between 15th March and 31st March as immaterial. So we'll take 15th March figure only for calculating fair value less cost to sell. And we found that in case of plant and equipment, there is a loss of 2 million. So that loss of 2 million we will provide. Is it understandable? Yes. Next paragraph, long-term borrowing. Now they are going to test IS 32 here. Similar problem in IS 32 you have solved. On 31st March 15, Alpha issued $30 million one convertible loan notes. The loan notes carry a coupon rate of 6% per annum, payable annually in arrears, and are redeemable at par on 31st March 2020. Means after how many years? 5 years. So this is a loan note, means bond, debenture. As an alternative to redemption, the loan note holders can elect to exchange their loan notes for equity shares in Alpha on 31st March 2020. So that means there is a conversion option. Since there is a conversion option, since there is a conversion option, that means we have to divide the liability component and equity component. If the option to exchange were not available, the investor in the loan notes would have required a return on their investment of 10% per annum. Discount factors which may be relevant are as follows. So two discount rates they have given to us. Which is important for us? 6% or 10% for calculating the value of financial liability? Haji? 10%. One present value factor is given for one single year, 5th year, and cumulative factor is given for 1 to 5 years. On 31st March 15, Alpha debited cash and credited long-term borrowing with 30 million in respect of this loan. Required, prepare the consolidated statement of financial position of Alpha on 31st March 2015. So we'll have to change the value of the loan appearing in the balance sheet. Okay. This 30 million I will remove, and in place of that we'll add the present value of the liability. I will also have to adjust the interest that they have charged. They might have charged 30 million into 6%, but we will charge the opening liability into 10%. So my retained earning figure will also undergo a change. So all this you have to visualize. Okay. So what we will do, we will solve. First you come to SOFP and you keep writing wherever the figures are there. So we'll start again. Alpha holds investment in two entities, beta, gamma, draft financial position. So please write yourself. Non-current asset, property, plant and equipment. It is there. Tick mark 3 lakh, tick mark 2 lakh 40,000 and tick mark 1 lakh 80,000. Okay. Then come to investment. Now investment would be, the total investment appearing in the problem is 267 for Alpha. Wait a minute. That includes investment in beta. So please come to note number 1 below. In note number 1 below, on 1st April 2010, Alpha acquired 120 million shares in beta by means of a cash payment of 234.5 million. Okay. Alpha also incurred directly attributable cost of 2.5 million associated with acquisition of beta and recognized the investment in its individual statement of financial position on at 237 million. Now there is a mistake they have committed. What is the mistake they have committed? The directly attributable cost should be charged to profit and loss, should not be capitalized. So understand the effect. Right now in the balance sheet, this investment is appearing at 237. Is right? 237. This is what they are showing. And total is 267. So 30,000 is outside. 30,000 is outside investment. 1 minute रुको. 30,000 is outside investment. What is the market value of this 30,000 rupees investment? If you look at note number 3, it is 33 million. Note number 3, 33 million. Is it right? So dear student, we will take fair value, 33 million tick mark. What is the fair value of beta? 43 million, tick mark. Gamma 11.60, tick mark. So tell me the total. How much is the total? Yes, please answer. Total of other investment is how much? 87,600. Wait a minute. Now that 234,500 cost of investment that you put under this heading in that goodwill calculation. Where is goodwill? Cost of investment. Write 234.40 here. Sorry, 50. 234.50. And the 2.50 which we have not considered here, you write off in the retained earning. So come to working note number 6, retained earning. Adjustment for acquisition cost of beta. Adjustment for acquisition cost of beta. How much will you adjust here? 2.50 means 2,500. $2,500 adjust here, negative. And there is one more adjustment which we need to do. What is that? Revaluation of other investment of alpha. On the screen, working note 8. 33,000 is fair value and its book value is 30,000. So how much we need to adjust? 3,000. 3,000. And what about the increase in value of the subsidiaries? Where we are going to put them? Increase in value of subsidiary. Somewhere we have to put this investment value has increased. In the balance sheet this is 40,000, but in the balance sheet this figure is 40,000, but now it is 43,000. Other component of equity. No, I am talking about beta. 3,000 increase here. Beta also increased by 3,000. Where? To net asset. So you have to go to net asset, na? That is what is my question. So now you come to this net asset of beta. Other component of equity. Can you see this line? Other component of equity on 1st April 2010 was how much? Read the note 1 below. You have to keep the entire question paper open. Is it 1,000 here? Given in note number 1 after 2-3 paragraphs. And now on 31st March, you go to the question book balance sheet. There you will find other component of equity of beta is 4,000. But that 4,000 is before, that 4,000 is before increasing the fair value. So if I increase the fair value also, 3,000, 4 plus 3, 7. 4,000 is in the balance sheet, other component of equity. In bracket write 4,000 plus 3,000, 7,000. And same thing will do for this other company Gamma also. Gamma other component of equity was how much? 2,000. Note number 2. 2,000. And by what amount this has gone up? This has gone up by 1600. In the balance sheet, investment is 10,000, but you have written 11,600. So 1600 add, so it will become 3,600. 2,000 opening is already there, and plus 1600. And they have mentioned that this 1600 is due to factors after the date of acquisition. So that I don't need to bifurcate while solving the problem further. Okay. So this was a small discussion on investment. Now current asset inventories. Kindly come to balance sheet. Inventory 90 plus 60 plus 45. Just add here, keep it pending. Tick mark 90, 60, 45. Trade receivable, tick mark 72, 46, 40. But if you want, we can do this adjustment also. We have discussed this 9,000 and 6,000 is intra-group receivable minus 9,000 minus 6,000. So you can give me the trade receivable figure in the outer column. 1,43,000. And then you come to cash and cash equivalent. 15,000, 10,000, 8,000. This 9,000 plus this 6,000 cash in transit. Kindly add and give me the total. How much? 48,000. Very good. Next line, total asset, equity, share capital. So share capital of parent company will change. It will not be 2 lakh. Why it will not be 2 lakh? Because they have issued shares to Gamma. 2 by 3 of 90 million. Is it right? 60 million shares they have issued. So first I'll give that effect. Come to goodwill calculation, working note 3. Third line. Shares issued to acquire Gamma. 60,000 into 2.90. How much it comes to? 1,74,000. So this is one effect, investment account debit. To share capital will increase by 60,000 into 1, 60,000. Is it right? So now you come to balance sheet. Share capital 2 lakh plus 60,000 into 1, 2,60,000. And one more effect I have to give. You have issued shares at a premium. So this will affect other component of equity of the parent. So there is a working note number 8 for that. On the screen, working note 8. Premium on issue of share to acquire Gamma. 60 into 1.90. 1,14,000. So this completes the second effect. Is it right? Investment account debit to share capital and to securities premium. Next item in the balance sheet is retained earning of the parent. So retained earning of the parent 367,500. Write down working note number 6. 367,500. And then there is a other component of equity, parent 5,000, write in working note 8. Parent. So parent items are over. Now share capital, retained earning of the subsidiaries. So come to working note 1, share capital of Beta. 1,50,000 and 1,50,000. No change. In both column, right? 1,50,000. Retained earning, note number 1 below. You will find 75,000 is written. Note number 1. And now in the balance sheet, it is 1,15,000. 1,15,000. And then what about the other company? Same thing. Working note 2. Share capital 1,20,000. 1,20,000. And retained earning. Now this will change because we have to find out retained earning on 1st of July. Question has given retained earning on 1st of April. So see, there is a note below in your answer sheet. This is the note for that. 45,000 opening balance plus 3 by 12 into 51 minus 45,000. So that means 6,000 into 3 by 12 also you will add. So I have given the working for that. So how much will you write in 1st July column? 46,000? Is it 46,500? And this is 51,000 closing balance. Okay. So now the problem is easy. Other component I think we have written. Yes or no? Next line. Provisions. Note number 6 first. Without reading note 6 we can't move ahead. The total provision is 12.5 which is appearing in balance sheet, but only 8 is worth recording as provision. Remaining we will reverse in retained earning. So in balance sheet write down provision 8,000. And go to your retained earning. What is that? Working note number 6. Third line, adjustment for disallowable provision. Plus or minus? Plus or minus? Plus, you are reversing the provision. Is it right? 4,500. Very good. It means now you have understood this chapter. Remaining questions can be given as homework. Long-term borrowing. Just tick mark in the balance sheet right now. Long-term borrowing. 3 figures you tick mark. 60,000, 45,000, 50,000. And these two adjustment I'll discuss later. Deferred tax. Deferred tax, go to working note 10. In working note 10, you add the 3 numbers first. Alpha, beta, gamma. How much it comes to? 82,000. Okay. 82,000. So this is your deferred tax. Trade and other payable, add in the balance sheet and write it in the outer column. There is no adjustment in trade and other payable. 45 plus 42 plus 33. 1,20,000. Short term borrowing, add 20,000, 10,000, 7,000. 39,000. Total current liabilities over total current liability, you can write if you want 1,59,000. Next line. Now adjustments. Note 1. Mostly we have done. On 1st April, Alpha acquired 120 million shares in Beta by means of a cash payment of 234.5 million. This we have written. Alpha also incurred directly attributable cost of 2.5 million associated with the acquisition of Beta. This also we have written in retained earning. 234.5 we have written in goodwill working, 2.5 we have written in retained earning. Total 237. Next line, there has been no change in the carrying value of this investment in Alpha's own statement of financial position since 1st April. It is the group policy to value non-controlling interest at fair value. Market value of equity share of Beta was how much? On 1/4/2010 can be used for this purpose. On 1/4/2010, the market value of one Beta share was 1.80. So come to working note 3. This will be required for working note 3 goodwill and working note 4 NCI. So can you check how many shares are held by NCI in Beta Limited? 30 million into 1.80, 54,000. So write 54,000 here. Write 54,000 in the 4th working note also. Over here. Now tell me, how many shares are held by NCI in Gamma? Same 30 million, 120 minus 90. And what is the note for Gamma Limited NCI? The market value of Gamma Limited was 1.50. So 1.50 into 30, how much? 45,000. And you write here also, last column, Gamma, 45,000. Okay. Next line. In note number 1, on 1st April, the individual financial statement of Beta showed the following reserve balances. These two figures I have written. The directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of Beta on 1st April 2010. Following matters emerge. Property having a carrying value of 150 million on 1st April 10, depreciable component 80 million. Means this is depreciable amount. Depreciable component means carrying amount minus residual value. Had an estimated market value of 180 million at that date. Depreciable component is 90 million. The estimated future economic life of the depreciable component on 1st April 2010 was 20 years. The property is included in Beta statement of financial position on 31st March 15. So this we will have to give two effect. Okay. One will be for increase in value and one will be for extra depreciation, but it will have a side effect also, deferred tax adjustment also. Is it right? So first you come to this working note 1, property adjustment. Write 180 minus 150. 180 minus 150, 30,000. This property is still in the books, 30,000. Extra depreciation. Now here be careful, we have to only consider depreciable amount. Earlier I would have provided on 80,000, now I can provide on 90. So I'll get 10,000 more for depreciation purpose, divide by 20 years. And how many years are over? 5 years are over. Between 1st January 2010 to our 31st, what is the year ending date given? March 2015. 1st April 10 to 31st March 15, 5 years are over. So 5 divided by 20, how much is that? 2,500. Now we'll come to balance sheet. In balance sheet, property, plant, equipment. This figure you tick mark, 27,500. Why 27,500 you will tick mark? 30,000 minus 2,500. Okay. So now will it affect my deferred tax liability also? Yes, but I think there is an adjustment in, no, gamma does not have this adjustment. So wait, first we'll complete plant and machinery also. Plant and machinery also, next paragraph. Plant and equipment having a carrying value of 110 million on 1st April 2010 had an estimated market value of 123 million. Beta has disposed of all of this plant and equipment since 1st April 2010. Okay. So what will be the effect now here? Only pre-acquisition 13,000. Post-acquisition dash. Okay. We'll come to deferred tax later. Next is the fair value adjustments have not been reflected in the individual financial statement. In the CFS, the fair value adjustment will be regarded as temporary difference for the purpose of computing deferred tax. The rate of deferred tax to apply to temporary differences is 20%. No impairment of the goodwill on the acquisition of beta has occurred. Now you see on this screen how much is the adjustment made here? 30,000 and this 13,000. That is 43,000. So therefore the deferred tax implication will be 30 plus 13, 43,000 into 20%, 8,600 DTL, 20% of 43,000. And similarly here 30,000 minus 2,500. This is not there now. That is 27,500 into 20%. How much is that? 5500. So that means the closing deferred tax liability will be 5500. This will go to balance sheet. So now you come to working note number 10. In working note number 10, write down on fair value adjustment in beta 5500. Actually, they have prepared a working note for this. Can you see working note 9 below that? Near that? Yes. So if you want, you can complete this table or do it as homework. You'll do it as homework. Property adjustment, plant and equipment, total, and then 20%, which I have done directly there. Okay. One more item is pending, then I will transfer it to balance sheet. Any query on note number 1? No impairment of goodwill. Very good. Note number 2. Come to note number 2. On 1st July 2014, Alpha acquired 90 million shares by means of a share exchange. This entry I think we have done. Alpha issued 2 share for every 3 share held in Gamma. This entry we have done here. 1,74,000. On 1st July, the market value of Alpha share was 2.90 and the market value of Gamma share was 1.50. Both figure I have used for valuation of shares and NCI. Next line. The share exchange has not been recorded in the draft financial statement of Alpha. Now we have recorded. Alpha also incurred directly attributable cost of 1.5 million associated with the acquisition and debited these costs to administrative expense in the draft statement of profit or loss. So this is a correct treatment. No further discussion required, no adjustment required. This is as per IFRS 3 business combination. Next line, on 1/4/2014, the individual financial statement of Gamma showed the following reserve balances. This also I have done. 45 million and other component of equity 2 million. Gamma leases all its property. We have decided no effect of this paragraph. No goodwill impairment. So note number 2 is also over. Note number 3 also we have done. Do you agree? Note number 3 we have done. Investment we have appreciated. Other component of equity we have adjusted. Note number 4 is pending. Intercompany sale of inventory. The inventory of Beta and Gamma on 31st March 15 included component purchased from Alpha in the last 3 months at a cost of 15 and 10 million. Normal margin is 30, but for subsidiary 20%. So now you come to working note 6 on the screen. Last second line. Unrealized profit on sales to Beta and Gamma. It is written 20% of 15,000 for Beta and 10,000 for Gamma. So you can write in one line only. How much it comes to? Is it 5,000? Positive or negative? And what will be the deferred tax on unrealized profit? Deferred tax will be 1,000. 20% of 5,000, 1,000. Negative or positive? Which is negative? 5,000 negative. Right. 1,000 is positive. Now second effect of this 5,000 in balance sheet. In balance sheet asset side, can you see I have written 5,000 negative here? Tick mark. And just tell me the final figure in the outer column now. 1,90,000. Second effect of deferred tax. This deferred tax you have done 1,000 adjustment. So this is DTA basically. Because carrying amount of inventory has reduced, tax base has not reduced. So DTA. So write here 1,000. But because the first two items are liability and this is deferred tax asset, in bracket write DTA, so that you will understand y plus, y minus. The students ask me this question on email every day. We are not able to understand when plus, when minus. What is the total? 86,500. Where will you write? This is DTA adjustment. and this was DTL adjustment, the previous one, because in previous one the book value increased, tax base was lower. So 86,500 in the balance sheet, deferred tax 86,500. As a homework today, you'll practice all these 4 questions that we have done, okay, without the answer. 2 things you will check: how much time do you take? Second, how many corrections do you do? How much right you can reach? Something or the other you might miss here or there. Okay, so next paragraph. Trade receivable and payable we have done. Provision we have done. Provision we have done. Right. Then next paragraph is IFRS 5 implication. Come to working note 5. In working note 5, understand there are 2 items which are held for sale: property and plant. Carrying amount of property is 12 million. So write 12,000 existing carrying amount. And carrying amount of the plant is 3 million. So you can write 3,000. Then lower of E means carrying amount, and fair value less cost to sell. Carrying amount is 12,000. Fair value of property 16.5 and the cost of disposal is 0.5. So it is 16. So fair value less cost to sell is 16. 16 or 12, whichever is lower. So I will write 12,000 only. 16,000. You can write for your understanding 16,000 or 12,000, whichever is lower. So I will take 12,000. For plant, the fair value less cost to sell is 1.05 minus 0.05. Minus 0.05. So 1. 3 or 1, whichever is lower. So I will write 1,000. So the effect is property no plus minus, but in case of plant, we have to write it down by 2,000. Okay. So what is the total amount that I am going to show in the SOFP? 13,000. What is the amount I am going to write off in the retained earning? 2,000. Okay. So this 13,000, and you can complete the table by writing total 15,000 here also. The table would complete. So now please come to balance sheet. In balance sheet, there is a special line: non-current asset classified as held for sale. How much will you write here? 13,000. And what about the 2,000 which you have written off in retained earning? What is that working note number? 6. Now here it is written: adjustment for held for sale asset. Write in bracket 2,000. Adjustment number 7 now. Long-term borrowing. It is a compound instrument actually. So what you will have to do, first find out the liability component. For calculating the liability component, compute present value of interest 6% of 30 million, 1.8 million, that is 1800, and the present value factor take from the question book only 3.790. So the present value of coupon payment, interest payment is equal to round off 6822 and present value of principal 30,000 into 0.621 18630 18630. So tell me the total. 25 452. So what will be equity component? Can you just tell me equity component? 30,000 minus 25452 4548 4548. Now come to working note 8. Immediately below that, this fourth line, equity element of convertible loan 4548 4548. And this 25452 45452 we have to add the interest also, na? When was the loan issued? No, interest issue will not come. The reason being, it was issued on 31st March 15. Year ending date is also 31st March 15. So dear student, interest effect will not come in the current year. So come to balance sheet. Let me explain long-term borrowing. You remove the loan which they have included, 30,000 minus, and add the present value of the liability 25452. And the difference between these two number already we have added in equity. So what is the final long-term borrowing in the outer column? 1,50,452. Okay. All adjustments we have done. Wow. Now the time to wind up the question. First come to working note 1. Now in working note 1, take the total. So this will give you net asset on the date of acquisition and net asset on the date of consolidation. Take total of the first column. Working note 1, first column total 260,400. Second column total 2,94,000. Wait. Now you see on the screen, I am going to highlight something. The other component of equity has changed from 1,000 to 7,000. So now there is a note below. First calculate the total change. 260,400 minus 2,94,000. That is 33,600. Out of that, 6,000 is due to other component of equity. Balance 27,600 relates to retained earning. So why I am telling you? Because accordingly the effect will be shown in working note on retained earning and working note on other component of equity. NCI is not affected because he has to write in same place. So now you see, first come to this goodwill calculation, beta column. Can you tell me how much was the net asset on the date of acquisition? 2,60,400 in bracket. Wait. Then you come to NCI column. Working note 4 beta column. Beta we have 20% stake, right? And NCI will get 20% of increase in net asset 33,600. So kindly multiply 20% of 33,600. 6,000? 6720? Okay. Come to retained earning. Working note 6 on the screen, 5th line. In retained earning, we will write 80% of increase in retained earning. 80% of subsidiaries retained earning 27,600. Come on, how much? 22080. And in other equity here, second last line, working note 8 on the screen, right side. 80% of increase in other equity, 80% of 6,000. 4,000, 4,800. Okay. And now we'll do the same exercise for gamma. Come to working note number 2. Working note number 2, take total of the first 3 lines. This is relatively easier. 1,68,500. 1,74,600. Okay. Now here also I'm going to highlight something, pay attention. The other component of equity has increased from 2,000 to 3,600. So 1,600 will be attributable to other component of equity. Total change, if you see the difference between these two numbers, is 6,100. 6,100. Out of that 1,600 is other component of equity. So 4,500 relates to retained earning. So now we'll go to goodwill working note. In goodwill working note gamma column, what was the net asset on the date of acquisition gamma? Is it 168,500? 168,500. I'll come to that. First complete second effect. NCI will get 25% share of 6,100. Multiply these two. So how much NCI will get? 1,525. Is right 1,525? Okay. Wait a minute. Come to retained earning. Gamma, share in gamma's retained earning. 75% parent share. 4,500 is increase in retained earning. So tell me this 75% of 4,500. 3,375. And in gamma's OCI, working note 8, 75% of 1,600. How much? 1,200. No. 1,200. 75% of 1,600. 1,200. Right. Okay. So working note 1 and 2 are over. Now come to 3. In working note 3, tell me goodwill in the first column. 28,100. Second column 50,500. And below I have written a note for you to cross check. The total goodwill is 78,600. Now also take total of NCI individual column first. Individual column NCI beta 60,720 gamma 46525, and below I have written a note for you. Total NCI is 1,07,000 245. Okay, come to retained earning total. Take total of retained earning. Total of retained earning. Three lakh. How much? 388, 950. Very good. And just one more total. Other component of equity. Other component of equity. One 132,548. Okay, loan we have transferred. Working note 9 is your homework. Working note 10, deferred tax we have transferred. Oh, done. Now you complete the answer. Please, everybody come to SOFP. Write there goodwill. How much goodwill you will write? Goodwill total 78,600. Then on the equity and liability side, write down retained earnings 388,955. Other component of equity, write 132,548. NCI, write down 1,07,245. Transferred. Take total of asset side. 1292700. 1292700. Total of equity and liability. Same. Sure. Amazing. 1292700. This answer is over. 1292700. So now we will take a break.